Getting from where you are financially to where you need to be can be viewed as a navigation problem. Portfolio navigation is the investment management process designed by Dr. Frank Sortino that focuses on an investor's financial goal and individual situation to direct their investment strategy. All navigation problems require the calculation of a heading to get you to your destination. We call the financial equivalent the desired target return, or DTR. It is the return an investor needs to earn on assets in order to achieve some future payout. Portfolio navigation uses an investor's DTR to select an asset allocation strategy and portfolio design well suited to achieve the investor's goal. And it monitors that investor's DTR for changes that would require a change in strategy. This case study illustrates the significant contribution portfolio navigation can make towards helping an investor achieve their financial goals. In the case study, we isolate the effect of portfolio navigation from market performance and portfolio design by using very simple portfolios comprised of the S&P 500 ETF and short-term bond ETF. It tells the story of Martha, who is 55 years old, makes $10,000 a year in contributions to her retirement account, and has accumulated $700,000 in retirement savings. When Martha begins portfolio navigation in May of 2007, we analyze her individual situation and generate a personalized MapFest report. We calculate Martha's DTR as 6% and tell her she is on track to replace 70% of her pre-retirement income at retirement. The MapFest report gives Martha critical information about her retirement savings progress. Since Martha's DTR is 6%, she is placed in the DTR Level 2 portfolio. At the end of May 2007, the S&P 500 is at 1420, on its way to 666 on March 2nd, 2009. That will be a decline of 53% in less than 2 years. As the market declines, Martha's account is reviewed on a quarterly basis, and she is kept appraised of the effect it is having on her assets. In March 2008, her account balance has declined to $674,450, which changes her DTR to 8%. Martha's account is moved to the DTR Level 3 portfolio, which contains a higher percentage of equity exposure. By September 2008, the market has declined significantly again, and Martha's account balance is now $625,601, and her DTR is 10%. Her account is moved to the DTR Level 4 portfolio, which contains an even higher percentage of equity exposure. And by December 2008, her account balance is $520,604, and her DTR is 12%. Her account is moved to the DTR Level 5 portfolio, which contains the highest equity exposure in the DTR Navigator program. At the end of the year, Martha is sent her annual MapFest report, which notifies her of the status of her account and recommends increasing her contributions to lower her exposure to equities. The market hits its bottom in March 2009 and begins its steady recovery. By December 2009, Martha's account has grown to $645,374, and her DTR has reduced to 10%. Her account is moved to DTR Level 4, and its reduced exposure to equities. By March 2011, her account balance has grown to $760,745, and her DTR is now 8%. Her account is placed in the DTR Level 3 portfolio with an even further reduction in equity exposure. Note that this is not a market timing approach. Portfolio navigation does not try to predict upturns and downturns in the market. The changes to Martha's portfolio are based on her needs, not the market. However, the effect of managing her portfolio by need causes Martha to purchase equities when they are less expensive and sell them when they are relatively more valuable. In this example, Martha's account balance grew by over 8% even during these turbulent times. While her account balance grew with portfolio navigation, the same investment in the S&P 500 index alone would still be down by over 7% in March 2011. Portfolio navigation also proved to be far superior to the emotional behavior of most investors during this time period, who pulled their money out of the market at the bottom.